What's crackin'? Picture this. You walk into your favorite chicken-themed cafe and you order your usual, a large espresso, you tap your card, and nothing. The machine just beeps. Now imagine that's not just your card. Everyone's cards are suddenly useless. The cafe's bank can't process payments, can't give out cash, can't even buy more coffee beans. Why? Because, get this, the bank just ran out of money. And yes, that can happen. Now, before we all turn into headless chickens, let's break this down together. First, let's clear something up. When we say a bank has your money, what we really mean is that they have a polite little note somewhere saying, yeah, we owe this person some money. Your actual cash, not sitting in a vault with your name on it, guarded by a rooster in sunglasses. It's been sent out into the world to help other people do stuff. Like Bob. Bob took out a loan to start his new business. Custom-designed, gold-plated chicken feeders. Huge market, he swears. Or Alice, who borrowed money to buy a cozy little farm cottage with room for 12 hens and a hot tub. Where did Bob and Alice get this money? From your bank. Specifically, from the big pile of cash that banks collect when you and others deposit your savings. But banks don't just sit on that cash. Instead, banks lend most of it out. This is called fractional reserve banking, which sounds like a complicated breakfast menu item, but really just means they only keep a small fraction of your money on hand at any given time. Let's say for every 100 eggs deposited, they keep 10 in the fridge and send 90 out to hatch into more eggs. Because when those 90 eggs come back, thanks to interest from people like Bob and Alice, the bank makes money. You get your interest. And everybody's happy. This works great until it doesn't. Because here's the thing, the bank is betting on one big assumption that not everyone will ask for their money back at the same time. And let's be honest, most of the time they're right. You use your debit card here, pull out a little cash there, maybe pay your egg subscription box online, but you don't go grab all your money and stuff it into a shoebox under your bed every Tuesday. So the bank's system works. But what happens if something spooks people? Let's say there's a rumor that Bob's gold-plated chicken feeder business is tanking. Suddenly, people start worrying. People rush to the bank to withdraw their cash. Not just a few customers, everyone. This is called a bank run. And yes, it's exactly what it sounds like. Customers literally run to the bank. They all want to pull their money out before it's too late. But here's the problem. Remember those 100 eggs the bank had? They only kept 10. The other 90? They're in Bob's chicken-shaped food truck and Alice's throw pillow-filled living room. So now the bank's staring at a lobby full of customers, all clucking for their cash, and they can't cough it up. They might sell off some assets to get quick cash, like those loans they made to Bob and Alice. But that takes time, and nobody in line has time. This is where things get dicey, because when one bank starts cracking under pressure, other banks start sweating too. If that bank is in trouble, maybe mine is next. They start pulling money from their banks, and the panic spreads like a coop full of hens spotting a fox. Now, banks are trying to grab money from other banks, but those banks are holding tight. It's every hen for herself. And since banks also lend money to each other on the daily, this breakdown in trust is a huge problem. Imagine if the hens stopped sharing food entirely and just sat in separate corners of the barn glaring at each other. That's what happens during a full-on financial panic. Still with me? Good, because here's where it gets really scrambled. Money in the modern world is kinda imaginary. Yeah, I said it. Most of it exists only as numbers on a screen. It's not physical, it's digital trust. You believe the bank has your money because the app says so. The bank believes you'll pay your loan because your file says so. Everyone believes the system will keep working because, well, it always has. Until the moment people stop believing. And this is why central banks exist. They're like the ultimate chicken mob, the one with extra feed stashed away for emergencies. When regular banks start running out of money, the central bank can swoop in with emergency funds. But even that has limits. Because if the whole flock loses trust, if nobody believes the bank will survive, then we've got ourselves a full-blown coup crisis. And that, my friend, is where it all can start to crumble. Money isn't just numbers or paper. It's a collective trust fall. A mutual agreement that this digital egg in your account has value, and that the coop isn't secretly empty behind the barn door. So when one bank runs dry, it doesn't just hurt the folks lined up outside. It starts a chain reaction. Other banks get nervous, businesses slam the brakes. Now let's imagine this panic grows big enough that the government has to step in. Governments and central banks jump into action like firefighters with water buckets, except their buckets are full of, money. In the US, this is done by the FDIC. In the EU, it's similar, just with more bureaucracy and slightly fancier accents. Now, most people's money is covered. People calm down, lines shrink, coup returns to order. But this is where we gotta talk about the second wave of problems. Because even if the panic settles, the damage lingers. Banks that almost went under, They're not exactly in the mood to hand out loans like free corn at the county fair. They tighten up, raise interest rates, ask for more paperwork than a chicken trying to apply for a passport. Businesses can't get the loans they need to expand. Families can't get mortgages. Students can't get loans for school. The economy starts slowing down, not because people don't want to do stuff, but because banks are too scared to help them do it. And when banks freeze up, it's like the whole financial bloodstream gets clogged. The economy stops pumping. At this point, central banks might pull out the big guns. And by guns, I mean policies with fancy names that sound like spells from a wizard textbook, quantitative easing, open market operations, repo facilities, and more. Let's unpack just one for now. Quantitative easing, or QE. QE is like this. The central bank basically says, okay, fine, we're going to create money and use it to buy stuff, usually bonds from banks. That way, the banks have more cash and they'll hopefully lend it out instead of hoarding it in a panic room. It's kind of like putting more eggs into the system to keep things flowing, even if it means some of them are a little digital, a little make-believe. This helps in the short term. Banks have more money. People feel safer, and the coup gets a little quieter. But QE isn't a free lunch. Flooding the system with money can lead to inflation, which is basically when your eggs buy fewer pancakes than they used to. And nobody likes that, especially not breakfast lovers. So now you've got this tightrope walk. Help the banks, calm the panic, get people spending again without accidentally cooking the economy in an inflation omelet. It's tricky, it's messy, and it's all based on timing, psychology, and keeping the vibe alive. Now back to our original question, what actually happens if a bank runs out of money? Well, short version, it triggers a trust crisis. And if it's not handled quickly, it spreads to other banks, businesses, and everyday people. It's not just one bank's problem. It's like one hen pecking too hard on the wire, and suddenly the whole fence collapses. This is why governments and central banks freak out when even a medium-sized bank starts wobbling. They don't wait until the feathers are flying. They step in early, offer loans, guarantees, backstops, even full-on bailouts if necessary. Let's take a quick detour to history class, shall we? In 2008, when some major banks in the US and Europe ran out of money, it was like the entire coup went silent for a second. Just pure terror. Businesses froze, stock markets dove like they saw a hawk overhead. People lost jobs, homes, and in some cases, faith in the system. Governments had to inject billions. It wasn't just about helping banks. It was about saving the financial infrastructure we all rely on. Because like it or not, we all ride the same egg cart. And while that panic has faded now, the scars remain. That's why these days banks are required to keep more reserves, run regular stress tests, and basically prove they're ready for a storm. Like a chicken with an umbrella, just in case. Still, the system is only as strong as our belief in it, because once people stop believing their money is safe in banks, they start pulling it out, the banks collapse, and guess what? Their money actually isn't safe anymore. It's the ultimate financial self-fulfilling prophecy. So yeah, when a bank runs out of money, it's not just a numbers thing, it's a people thing, a trust thing, the whole coop clucking together thing, and it can be managed. With the right tools, smart policy, and a little bit of calm, it doesn't have to turn into a full-scale financial feather fight. So, in conclusion, banks running out of money sounds like a wild disaster movie, but it's actually more like a chain reaction of nerves. Most of the time, it doesn't happen. And when it does, the system is built to catch it before it spreads. But the real secret sauce, trust, belief, the collective chicken energy that says, yeah, my money's safe, we're good. Because once that's gone, even the strongest coup can crumble. If you want me to make other videos explaining these topics, please like and subscribe.